Hey guys, and welcome to Market Mondays. Yes, we are back. And if you and I haven't had the chance to meet each other yet, my name is Sasha Kesed. Welcome to my YouTube channel. Please subscribe and comment below. Introduce yourself to me so that I'll know who you are. On Market Mondays, we cover the economy. We cover a lot of things that may or may not impact real estate, but it's important to us. And what matters to you and I in the real world is what we talk about here. So today, the question is, how did we get here? The economy as a whole, inflation is the key word of the day. How did we get here and why are we here? So why are we where we are? Well, the first factor is COVID-19 and supply chain disruptions. I mean, think about it. COVID-19 caused a lot of countries to shut down their borders. That doesn't only include travelers. That also includes the exchange of manufactured goods. And as some countries had to shut down their borders, there was created the shortage of, well, we can't get this product in, so we can't move forward with our leg of the journey and what we need to do with that product. So now we have a shortage and we need to either find a way to make up for that shortage or we really felt the impact. And I feel like a lot of industries felt that impact. We have to keep in mind that we live in a global economy where countries are so interdependent on each other that a disruption in one causes a disruption in the next and the next and the next. It's like a cause and effect pattern, like a set of dominoes that you line up very, very carefully and everything is running smoothly, and then one thing flops and then another thing flops, and now you have this cascading effect. Here's an example for you. Between May of 2020 and May 2021. So think back like a year ago and then a year ago from that, right? May to May of 20 to 21. Well, the lumber prices rose by 145%. And that's because Washington, well, I live in Washington State, but that's because the US had to shut down its borders from a lot of different things. Between Canada and US, that border was shut down. So all of a sudden, we couldn't get our lumber from Canada in order to process it here, in order to continue building our homes and doing remodels. So every business has a bottom line, things that they need to account for, if you will, in their bookkeeping process, like paying contractors, keeping employees running, paying medical and what is that called? Sick leave. Yes, vacation time, PTO, all of those things that a company would have. They also have the things that they need to purchase, like raw goods, raw materials. So when a client comes and they're in contract and now the price of lumber is rising, either the company's bottom line increases and the contract price is the same, so now the company earns less and less. When it hits really close, then the prices need to rise to the customer as well. So what we've seen is, and I'm not talking about businesses, like people think businesses earn a ton of money and it's all in the millions. In fact, most businesses in the US are small businesses. It's like mom and pop shops, remodelers. They're just like a family at a time, or maybe an owner and a couple of partners. And you think about even medium-sized businesses, those are not that big as well. So they're capped. The amount of money that they're left over with isn't as much because they need to keep the company running. If anything is if anything is troubling the company, it's on the owners of the company to keep it running. It's also on the owners to pay for all those things that we mentioned, but also they need to earn some money to simply pay their rent or their mortgage and to provide for their families. So I'm not talking about companies that have millions and millions of dollars in revenue. I'm talking about regular folks like you and I. So for those businesses, this price hike in, let's say, lumber, that affected all of the remodelers, that affected decking, that affected fencing. Framing is a huge part of building, and if you're even doing remodel, chances are you're working on that framing as well. There are so many things that affected it, including furniture prices, including, hey, cat towers, if you will. There are so many things that were affected by inflation that rose from the shutdowns, that rose from the necessary precautions that were taken from COVID-19. So we can group it all as one: COVID-19, supply chain shortages, and inflation. And that by far are the biggest factors from the last 2 or 3 years of our lives. When we think about other industries, office space, commercial is coming back in business. They are not going down. In fact, they're coming back up now because a lot of small businesses were actually started due to the shutdowns, when people were sitting inside their homes and they had more time to kind of develop their skills, develop their hobbies, and take that chance in starting new business. And now they're ready to grow those businesses and maybe lease some commercial space. But think about during the shutdowns, or during just the COVID-19 closures, in whatever shape or form the limitations were where you were, there were still effects on even commercial real estate. When people were working from home, they didn't need the office space, but a lot of companies kept that office space running, and in doing so, they were helping the economy. So again, hats off to you guys, business owners, who are not just looking out for yourself. You're looking out for the people that you're renting the lease space from. You're looking out for your employees. You're looking out for your company's bottom line, but also so many other, maybe little factors, maybe bigger factors that are not taken into account of often enough. Another factor that's playing into this high inflation period where we find ourselves in is the interest rates. Right now, interest rates have started to climb. Yes, I do know that, but think back to how long has it been since they started to climb, or how long have they been at the bottom lows? If the interest rate is high, then it costs more to obtain the credit. If the interest rate is low, it's easier to get credit because it costs less, so you can afford more. So because we had the low interest rates for so long, a lot more people could afford to take on the credit. And on the one hand, it's great because it stimulates the economy, but if it goes on for too long, that means that the economy stagnates. And when the economy stagnates, you need to do something. Well, consumer behavior is hard to change, except for if you raise interest rates. So as the economy stagnates, now we have higher inflation. So what do? We increase the interest rates. And the Federal Reserve has the power to do so. They meet regularly throughout the year, and they have a cap on how much they can raise the percent every time, but they are raising it, in fact. And that's because as they raise the interest rate, for people, it costs more to obtain that same credit. And that means that people are going to voluntarily choose to hold back a little bit and either not take on as much of a loan or not take on the loan itself. And by doing that, so the Federal Reserve is encouraging saving, and that is supposed to decrease the inflation rate. And in fact, it does combat inflation rate. But the question is, has it been too long? And in all honesty, when we look back, it's called history. When we look forward, it's called a prognosis. Anything that anyone can tell you at this point is just a prognosis of where do we think we're going. But the truth is, we have been in the low interest rates for far too long. And if we would have just started to climb those interest rates a little bit at a time, a little earlier, I'm finding my words, a little bit earlier, then we could have had like a smoother slowdown, maybe a smoother slowdown to the inflation, so that we would come back up to normalcy. But now that it's been so long, now we're seeing like one increase after another to try to take a really, like you see in those movies where it's like a train is going way too fast, so they pull the thing down to try to stop it. And that's kind of what's happening. Like all the energy is on the lever and they're pulling it down, and it will work. The question is, how much of the time do we need to catch up to normal levels, and what will get affected in the meantime. But if we had just started to climb those numbers a little earlier, we would have seen a smoother transition. Now that we are in inflation, though, it's just a matter of time. And a matter of time for what exactly? Some people are preparing for a recession. Some people are preparing for something even worse. Others are saying, no, this is just gonna go a little like this, but it's gonna even out and nothing will change. Other people are thinking it's gonna keep going indefinitely and inflation is just forever going to exist in our lives. I think the middle ground is the most realistic one, because I saw this chart recently and I would like to bring it on and show it to you guys, but it shows the recessions in the periods past. And yes, we have had recessions, but not every recession actually affected all of the industries. For example, now we take it back to the real estate side of things. Not every recession actually affected house prices or brought house prices down. Even during some recessions, we had just a leveling off of the home prices, or we had like a slight increase and then a slight dip. And so technically it is the same as leveling off, because we've just been watching it like a little bumpy road. But not every recession has signaled like $50,000 or $100,000 fall. And a lot of people are waiting to purchase their home, and they're like, okay, Sasha, I'm just gonna wait it out until everything falls, and then prices are going to be amazing again, and things are gonna be affordable again. And I make no guarantees or promises of that. What you decide today is going to be your history tomorrow. For real estate, when you look specifically for real estate, when you look back at how many people created financial stability in their lives, is by taking on responsible loans. It's not taking on a loan that's beyond your means, or trying to match the next person and buying the same bigger house. If you can just start off with like a condo and feel like you can, if you don't want to live in it, you can rent it out like a short-term rental, or if you're next to like a hospital or a university or a place that's very populated and you can rent it out even as a long-term rental, you're making a great financial decision. But if you're constantly taking money that you don't have out as credit and putting into something else, hoping that maybe, just maybe, you can hold on to everything, that is not responsible financial situation to put you or your family in. So I always advise my clients to talk to a loan officer that will be able to explain to them all of their options, but also what those options will mean to them on a monthly basis. And then it's up to my clients to decide what they feel is the best decision for them. So thank you for joining me on another episode of Market Mondays. Next week, we'll go over those recessions and we'll talk about how they started, and was there any time period that we saw that kind of led to a different little bit of a faster insight to when they happened, and what did those recessions actually mean in people's pocketbooks? What did it mean for people to have extra money or not have it, to do entertainment or invest in real estate, and prices of homes? Were they going up or down? We'll take a look at that next week, so stay tuned.